Okay, so let's try to make sense of this. The biggest banks, they're reporting absolutely record-breaking profits. So why in the world is the CEO of Wells Fargo telling everyone he's nervous? Well, it turns out it's what's off the balance sheet that really matters. Today, we're going to dig in, solve this paradox, and figure out just what has Wall Street's top brass looking over their shoulders. All right, let's get right to the heart of it. This quote, this is from Charlie Scharf, the CEO of Wells Fargo. He says, "Everyone's nervous. I don't care what the results are." I mean, just stop and think about that for a second. That is a stunning thing for him to say. You've got one of the most powerful bankers on the entire planet basically shrugging off record profits and telling you he's worried. That's not just a red flag, that's a giant flashing alarm bell. It tells you he sees something, something lurking just beneath the surface that isn't showing up in those glossy headline numbers.
And look, on the surface, the results are incredible. Just take JP Morgan Chase. In the first quarter of 2026 alone, they pulled in a staggering $15.41 billion in profit. Billion. For a lot of the big banks, these aren't just good numbers. We're talking some of the best they've ever had, mostly thanks to a big comeback in investment banking. So you'd think the champagne would be flowing, right? Well, it is, but the mood is definitely tense.
So that's the big question we're trying to answer here. If the money is just pouring in, why all the nervousness? Why is there so much anxiety coming from the very top? Well, the answer, as we're about to find out, isn't on the front page. It's hidden away in the shadows of the financial system. So let's go digging. Let's find some clues. All right, clue number one. This one is actually hiding in plain sight. It's a problem you can literally see right there on the balance sheets, a headwind that's already starting to bite. We're talking about something called the margin squeeze, and it hits right at the core, the very engine of how a bank makes money.
Okay, so to really get this, you got to understand how a bank's business model works at its most basic level. It's actually pretty simple. They take our deposits, right? And they pay us a tiny little bit of interest for them. Then they turn around and lend that same money out for things like mortgages and car loans, but at a much, much higher interest rate. That gap, the difference between what they earn on loans and what they pay out on deposits, that's their core profit. It's called net interest margin, or NIM for short. It is quite literally their bread and butter. The problem is that bread and butter profit margin, it's getting squeezed. I mean, really squeezed thin. You know, the forecasts were all pretty optimistic. Take JP Morgan again. They were expecting a nice healthy NIM of 2.57%. But the reality? It came in closer to 2.5%. And even worse, they had to lower their expectations for the entire year. So what gives? Well, it's a brutal price war out there. Banks are fighting tooth and nail for loans, which means they have to slash their rates to compete. And every time they do that, it just eats directly into their profits. This is the first real, visible crack in the armor.
Okay, let's move on to clue number two. And this is where things start to get really shaky, like the ground beneath the bank starts to feel pretty unstable. We're digging a layer deeper now, into a risk that, yeah, everyone kind of knows about, but they might be dangerously underestimating it. We're talking about the foundations of the commercial real estate market. Just look at this number, $817.2 billion. Let that sink in. That is the so-called wall of maturity. It's this colossal mountain of commercial real estate debt that all has to be refinanced in 2026. And here's the really scary part. Most of these loans were originally signed when interest rates were basically zero. Now, all these property owners have to go back to the bank and refinance at today's dramatically higher rates. That creates this huge, and in many cases, completely insurmountable funding gap. So you might be asking, how are the banks handling this, especially the smaller regional banks who are just loaded up with these kinds of loans? Well, if you look at their official books, everything looks pristine. They're reporting delinquency rates under 1%. Looks great, right? But what's really happening is a whole different story, and it's much more troubling. The latent distress, that's the real situation, where the property is actually worth less than the loan on it. That number is more than 4 times higher than what they're officially reporting. It's like there are two sets of books, the one they show the public and the one that reflects cold, hard reality. How is that even possible? How can they do that? Well, it's through this really dangerous accounting trick called extend and pretend. Let's walk through the playbook. So you've got a loan on some half-empty office building, and it's about to mature. Now, instead of making the owner sell the building and taking a big, painful loss on their books, the bank just refinances it. They extend the loan and pretend everything's just fine. And here's the crucial part, step 3. They don't make the borrower put in any more cash to make up for the fact that the building's value is tanked. So the loss, it never gets officially recognized. The ticking time bomb just gets reset and kicked further down the road. Okay, This brings us to clue number 3. And honestly, this is the big one. This is the clue that really explains why those CEOs are so nervous. We are now venturing into the shadows, into the huge, totally opaque, and pretty much unregulated world of private credit. It's a $1.8 trillion world. This is the non-obvious angle, the real story behind the story that a lot of people are completely missing.
See, in this shadow market, the rules are just different, and the risks are buried deep. For starters, the valuations are, let's just say, creative. Because these are private loans, there's no stock market ticker telling you what they're worth. They're valued internally, inside a black box, which makes it almost impossible for anyone on the outside to know their true value. Next up, defaults are being hidden. Companies that are struggling are actually allowed to pay the interest they owe, not with cash, but by taking on even more debt. It's called a pike toggle, and it is the financial equivalent of paying off your Visa with a MasterCard. You know that's not going to end well. And finally, the whole system is just fragile. A lot of these loans get bundled up together into these complex things called collateralized loan obligations, or CLOs. And right now, some of the critical safety tests on those CLOs are flashing red, which is a really bad sign that the whole structure is under stress. And if you want to see what that stress looks like in the real world, here it is. A full 20%, that's 1 out of every 5 companies borrowing in this private market, now has what's called an interest coverage ratio below 1. What does that mean in plain English? It means they are not making enough money from their actual business to even cover the interest payments on their debt. They are, for all intents and purposes, insolvent. They're zombie companies, kept alive only because lenders are willing to keep pretending that everything is okay.
You know, whenever you hear a bunch of executives insisting that everything is fine, even when all the data is screaming the opposite, you should probably be a little skeptical. This quote here from Enron's CEO Ken Lay, he said this just a few months before the company completely imploded in one of the biggest scandals in history. It's a pretty chilling reminder, right? History teaches us over and over again to pay way more attention to the numbers than to the reassurances. So let's do that. Let's connect these numbers and see how all of our clues are on a collision course.
So how does this all connect? You've got the squeezed margins, you've got the cracks in commercial real estate, and you have this massive shadow bubble in private credit. Well, the answer comes into focus when you look at the 2026 bank stress tests. They basically show us exactly what happens when all of these problems finally crash into each other. And what those stress tests revealed was a huge divide. It's really a tale of 2 different banking systems. On one hand, you have the big guys, like JP Morgan. They passed. Their balance sheets are diversified, they've got enough capital to soak up a big economic shock. They can afford to be nervous. But for the regional banks, it's a totally different story. In a scenario that is very, very plausible, a 30% drop in commercial property prices, a whole bunch of them become undercapitalized. Their safety cushion just gets vaporized. For them, this isn't just a worry, it's an existential threat. And this right here is the final jaw-dropping piece of the puzzle. This is the connection. Why are the supposedly safe big banks so worried about the unsafe regional banks and that whole private credit market? Because they are all tangled up together in this giant, messy web. The big global banks, they have a staggering $4.5 trillion of exposure to the shadow banking world. So here's the big reveal, the whole point. The big banks aren't nervous about their own balance sheets. Those are pretty solid. They're nervous because they know the entire system is connected. They know this extend and pretend game can't go on forever. They know that a wave of defaults in private credit could set off a chain reaction, a cascade of failures among all those smaller, more vulnerable banks. And they know that that kind of contagion, it could come rushing right back and knock on their own front door.
Okay, so we've kind of unraveled the mystery, but what does it all mean for you, for us as investors? How do you navigate a world where everything on the surface looks calm, but you know the undercurrents are incredibly dangerous? Let's get into the playbook.
All right, what the analysis suggests is that you need to play defense. First, prioritize safety above all else. In this kind of environment, you want to be first in line to get your money back if things go south. That means focusing on what's called senior first lien secured debt and make sure the underwriting is rock solid. Second, go on the hunt for distress. The shakeout that's coming is going to create some amazing opportunities to buy great assets from all those zombie companies we talked about, the ones that just can't survive now that cheap debt is gone. And third, and this is a big one, beware the liquidity mirage. You've got all these private evergreen funds that promise you can get your money out anytime you want. But guess what? When everyone rushes for the exit at the same time, they slam that door shut and lock up your money. We've seen it happen. So be really, really cautious with any fund that promises easy liquidity for assets that are, by their very nature, not liquid.
And that brings us to our final thought, and it comes from JP Morgan's own CEO, Jamie Dimon. He calls it the cockroach theory. The idea is simple. When you see one cockroach, you know it's never just one. It's a sign that there are 100 more hiding in the walls. And that's why the big banks are so nervous. They've started to see a few of those cockroaches scurrying out from the shadows, and they have a pretty good idea of what's coming next.